We just got some pretty exciting news regarding a high-yield dividend stock that I've been a shareholder of for many years. On Wednesday, after market close, Capital Southwest, ticker CSWC, announced that they'd be switching from paying quarterly dividends to monthly dividends. This is according to the press release taken from their website, which says, Capital Southwest announces transition to monthly regular dividends and declares total dividends of 64 cents per share for the quarter ending September 30th, 2025. This BDC has been a really solid performer in its sector for a long time, and the news we got coming out on Wednesday makes this stock even more appealing in my opinion. Capital Southwest Corporation, an internally managed business development company focused on providing flexible financing solutions to support the acquisition and growth of middle-market businesses, is pleased to announce a change in its regular dividend payment frequency from quarterly to monthly beginning in July of 2025. In addition, the company is pleased to announce that its board of directors has declared monthly regular dividends of 19.34 cents per share for each of July, August, and September 2025, and a regular supplemental dividend of 6 cents per share that's payable in September of 2025, each of which is detailed in the table below. Michael Sarner, President and Chief Executive Officer, stated, "We believe that transitioning to a monthly regular dividend is a shareholder-friendly initiative which will benefit all shareholders of Capital Southwest. We are pleased with the strong earnings generation and credit quality of our portfolio, which allows us to continue to distribute significant recurring dividends to our shareholders." As stated, they provide this chart in the press release, which shows their new monthly dividend amount, which will be 19.34 cents per share, and they also announced a special dividend that's going to be paid on September 30th. That'll be a bonus of 6 cents per share, bringing their third quarter dividend payment total to 64 cents. The new dividend amount is funky, but that's so that there won't be a dividend cut. The amount shareholders will get this quarter will be the same as in Q2. So this again is all really good news. Capital Southwest has one of the best track records in the whole BDC sector. Their returns have been exceptional over the past decade, and they have a strategy that sets them apart from other BDCs. So let's go ahead and take a look at this company and see how they've been doing so far this year. To start things off, Capital Southwest has a bit of an unusual backstory to them. They're the oldest BDC in the sector, having been classified as a BDC since the year 1988. These kinds of companies didn't exist until the year 1980, so this would make them the oldest still in operation in their whole sector. They didn't, however, have the same strategy that they used to. In 2015, Capital Southwest transformed their business in order to pursue more income-focused investments, because up until that point, most of what they held were equity positions. These, although they can result in good share price gains, don't offer significant yields. So what they did was, they spun off most of their existing investments into a new company called CSW Industrials, which is still in operation and trading today. Pretty much everything that went into CSW Industrials was equity investments that weren't yielding much. This freed Capital Southwest to pursue more higher-yielding investments, and the results have been excellent for them. Unlike many business development companies, Capital Southwest is also internally managed. Although externally managed BDCs aren't necessarily bad in nature, and in fact my favorite BDC is externally managed, internally managed BDCs align management's best interest with that of shareholders. When you have an external BDC, usually the management team is compensated based upon assets under management. The actual performance of those investments that they pick doesn't really determine how much they'll get paid. It's all about attracting as big of a portfolio as you can. But with internally managed companies, the executives are compensated on the company's performance, not how big they are. So you can imagine that internally managed BDCs are much more attractive for this reason. What's also worth noting is that this company just got a new CEO. On February 18th, it was announced that Bowen Diehl would be moving from his position and that the company's chief financial officer, Michael Sarner, would become the next CEO. Diehl had been with Capital Southwest for 11 years, and he oversaw the transformation that took place with having the company move its equity investments into a different company. It was said in the press release that he intends to stay with the company for at least another year as an advisor to oversee the transition. So this updated dividend policy is literally one of the first moves that this new CEO is making, which is definitely encouraging. Let's look at their dividend history, which is one of the best in the BDC sector. Since their strategy shift, they've never gone through a dividend cut, and they have a really good track record of occasional growth and special dividends. You can see before 2015 they paid semi-annual dividends, which was really strange for a BDC. But then again, they didn't earn much since most of their investments were in equity positions. But since 2016, they've grown their dividend from 4 cents a quarter to 58 cents per quarter. Now, the vast majority of that growth came during the restructuring of their portfolio, so don't assume that we're going to continue to see that same level of growth going into the future. They also have this slide in their most recent investor presentation, which does a better job of showing their dividend history since September of 2021. There wasn't any growth in their distributions for a year during the height of the pandemic, which is understandable. And it's likely the reason why they're showing a 4-year dividend track record instead of a 5-year track record. But the blue represents their base dividend, which they've grown by 31% since 2021. The orange represents supplemental dividends, which you can see have been very common. In the majority of their quarters, they have paid one of these supplemental distributions. These can be thought of as a one-time bonus, in that the company did so well that they chose to reward their shareholders with an additional dividend payment. There's also this green part, which they classify as special dividends. They don't happen very often, but in theory, they could be thought of as yet another addition to their other dividends. So overall, this is some of the best dividend growth and special dividend amounts out of all business development companies that exist. I know up to this point I've been heaping praise upon praise for Capital Southwest, but we need to turn our attention to a couple of the concerns that exist. Because despite this amazing track record, Capital Southwest is not the healthiest company financially in this sector right now, in my opinion. So let's look at their most recent financial results, which came out on May 14th. Starting off with some good news, their non-accruals went down sizably compared to their previous quarter. They currently represent 1.7% of their portfolio at fair value, which is an improvement from 2.7% just 3 months ago. So the companies that they're investing in appear to be performing better at this point. But there are 2 pretty important metrics that have been falling for the past few quarters that should be monitored. First, their weighted average yield on debt investments has been going down for the past few quarters. This is how much their debt investments are yielding on average. 6 months ago, Capital Southwest was earning an average yield on their debt investments of 12.9%. 3 months ago, it went down to 2.1%, and in their most recent quarter, it was 11.7%. This means that this company is slowly earning less from their investments as time goes on, which can put their dividend at risk. The second metric that goes along with this is their dividend coverage. This has also been going down over the past 6 months. Their LTM dividend coverage, which stands for last 12 months, was 119% 6 months ago. 3 months ago, their coverage fell to 115%, and now it's currently 110%. So that is another concern that we'll have to keep an eye on. One more piece of good news is that their net asset value has been growing, which is a good sign. But again, that falling dividend coverage and the lower yields on their investments will need to be monitored. However, there are 2 pieces of good news surrounding this. The first is their sizable supplemental dividends. If things were getting too tight in terms of dividend coverage, we would see them lower or even eliminate these additional dividend payments. Fortunately, this hasn't happened yet. Second, Capital Southwest has really been increasing their new investment activity. This has been adding more investments to their portfolio, which will help bring in more income. Of course, it could be a double-edged sword. If they happen to be lowering their standards when it comes to lending, then it could potentially lead to a weaker portfolio overall. So in the end, I don't see any reason to be overly concerned with this company right now. Like I mentioned, coverage and portfolio yield will need to be looked at, but the fact that they're still doing well with their supplemental dividends is a good sign right now. Let me know your thoughts and if you think Capital Southwest is worth the investment right now, especially with those monthly dividend payments. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.